Tattooed Chef. Let's go take a look at it in our software. So Tattooed Chef in early 2021 was sitting at it hit a high of $25, $27 a share.
$28 on 9/18.
Yep. And now it's at $1.57. I don't remember exactly what we said about it, but basically I said, avoid it like the plague. All these hype stocks, I said, avoid like the plague. Let's look at the financials here about why I want to avoid it. Guys, remember, rule number one in investing. If you don't understand the business and how they're going to make money, avoid it. That's rule number one. So back then, this is the company that was going to crush it till it could, had no possible way of doing anything but doing great. Look at this. It did 118 million in the previous. Here was 200 million. And guys, guess what? It's barely grown since.
Yeah, can we look at quarter to quarter here real quick?
So let's go take a look at the financials of the company. Let's go look at the income statement by quarter. So guys, growth is exciting. It's super exciting. But remember, growing is not easy. It takes a lot of effort to grow. It's not just like, oh, if it was just easy as saying, well, this company's grown a ton in the last year, that's going to happen forever. This is the number one mistake made by investors. And I put investors in quotes because a true investor has margin of safety. But when you extrapolate 1 year of growth out to forever, it's easy to sit there and get stuck on how $26 for a company like this makes a lot of sense. It's $1.57 right now.
So this is where people in 2020, 2021 that were just getting into the market just assumed, oh, it doubled in growth. It's going to double again and then double again and just keep doubling.
Correct. So it's lost like 95% its value, maybe a little bit less than that, 93%. It's a $130 million market cap company right now. And all we said was, how do you justify the what's it called? It would have been $2 or $3 billion in value. I didn't get that. And people said, oh, you're a FUD, you're all this. It's like, okay, but my goal as an investor, repeat it over and over, is to find companies that have a track record that I can sit there and reasonably estimate what they're going to make in the future. Now, does that mean there aren't going to be some semi-speculative plays? No. You go watch our videos on Palantir. Palantir hasn't shown net income consistently. They've shown 8 quarters of cash flow, but they have a lot of growth potential. And now with being cash flow positive, it is much easier for me to understand how they can go about making more money in the future. You look at a company like Tattooed Chef. Look at their gross margin, 0.2% in the last year. Guys, this is before paying all overhead costs. Their profit margin is negative 42%. They're so early on, you have no idea how much they're going to make in the future as they grow. So
they actually pay a dividend.
No, they don't.
Why?
Oh, they did last year. The forward dividend's not there. Let's go look at analyst estimates here.
Wow.
On our software. Loss. Okay, next.
This actually surprises me.
Revenue.
Yeah.
Look at this low growth of revenue, guys.
Really surprises me.
The analysts are sitting here saying, what, 10% a year at most?
For a growth
How is
company?
that? What was that?
For a growth company?
Yeah, come on, guys. Growth company at 10% a year? Give me a break. Just a company like Microsoft should grow at 5 or 7% a year just based on the economy growing at 5 or 7% a year nominally. That's just like, I don't get this whole idea of, remember, that's nominal growth, not real growth. Nominal growth. That's before inflation when I say that. So if you're watching this and you like what I'm hearing saying so far, and you see the fact that, by the way, this isn't the only company. There are so many companies out there that we sat there and said, avoid. Workhorse, Tattooed Chef, Palantir, all these companies that all fell tremendously. And one of the things we said was, we just don't get it. And people said, oh, that's exactly the point. You don't get it. No, if you don't get it, avoid it. We've been saying about Bitcoin. We've been saying about crypto. We just got told recently by a friend of ours that crypto and Bitcoin are different things. Okay. No offense to him. I'm sure he's going to write me a text saying, Paul, it's like, you're wrong. I'm like, okay, then I'm wrong. I don't get the differences, so I avoid. I did not understand Tattooed Chef. I don't think there's a single company that we sat there and said was purely speculative that is not down at least 70 or 80% right now.
No, you're right. I just pulled up the Peloton chart, $171 high, currently like $10.
No, it was actually 180 high, I think.
Oh, maybe that was intraday high.
Maybe.
Yeah, but either way, that's a lot.
What's it at now?
$10.
Oh,
and
so
change.
it's up.
Back, baby.
It was at $8 or $9 before, wasn't it?
50 cents.
It was $8.68. Look at that. Or $6. What's that price? What's the low? 52-week low.
$6.68.
Oh, so it's up from its low. Good for them.
Back, baby. What were some of those other stocks you were just saying?
Workhorse.
Let's see.
WKHS.
Let's see.
So high of 43, currently at $2.12, which is a 52-week low. Okay, what about Nikola?
All right, let's see. $93.99. Current price
$2.
That's cool.
Okay. What about Peloton? You showed Peloton already. What about Neo? Even Neo was Even NEO was a stock that fell a lot.
Let's see, $67, $10.
Okay.
Right now. Actually, let's put in Palantir. It was the same deal.
Palantir was one high of 45 on the nose, I think.
Yeah, 45 on the nose, $7.20.
And by the way, watch our Palantir videos. I said in the early videos that if it was around $5, I'd be interested. When it fell to 10, I was like, okay, let's take a look at this. And I think the Palantir growth story with their gross margin and their cash on hand makes it a very, very interesting company. And I've said this and I have puts on it at much lower prices than today. But the point is, I follow valuations. I don't care if the stock, I actually prefer the stock is down 90% because I can take a look at it. But look at a company like Peloton. I still don't get it. Look at Tattooed Chef. Yeah. I still don't get it. All these things I don't get, I have to avoid. Palantir, I can understand that story a little bit better.
And they're producing free cash flow consistently.
And they have 8 quarters in a row of free cash flow.
Yeah.
Which is hard to do when you're a growing company. But these guys are not doing it. That is my point. That is the thesis of what we're trying to talk about here over and over again. It's not about sitting there and finding the stock that goes up and up and up. It's about finding the fundamental business where the stock and the intrinsic value are disconnected, where price is lower than intrinsic value. If you can do that, you can make a lot of money. But you should be okay sitting there and doing nothing. Don't follow the chart. Don't follow the hype. That's not the way to do it. This was a SPAC deal, right? I assume Tattooed Chef was a SPAC deal, considering how the stock was flat right here. And then all of a sudden, skyrocket, and all people saw was this. Look at ARK. ARK Investments, boom, the biggest one. We criticized every ARK holding. We did a video once, as Mo pulls it up, where we did the top 20 ARK holdings. 17 of them were losing money. And she said, you don't get disruption. Sorry, Kathy Wood, you don't get investing. Look at ARK. We said in February of 2021, we put videos out. People said, you're so dumb. She has a hedge fund, which she didn't have a hedge fund, but she has a hedge fund and you have a YouTube channel. The stock was at $160 a share. Yep. And now it's at $35 a share.
I mean, it's really close to its 52-week low.
Yeah. So guys, Tattooed Chef, I still don't get it. Let's look at the cash flow statement here for Tattooed Chef.
You're not going to like it. I already looked.
Quarterly. Oh, wow. Okay. Their only positive quarter was the very first quarter we had data on. Guys,
$3,000
doesn't mean that means the stock is zero. It just means like, hey, do research on Tattooed Chef. Let's do stock analyzer tool just to see what has to happen. Now, this is our tool that we use to make assumptions about the future because every investment is the present value of all future cash flow. So let's use our assumptions about the future. Let's make grandiose assumptions. But here's the hard part, guys. What do I put in for profit margin? What do I put in for free cash flow margin? We have no understanding of what it'll be. We have no understanding. We don't even know what the gross margin is. I have no clue what the gross margin of the company is because right now they're showing 0.2%. That means for every $100 that they bring in revenue, they add 20 cents to the bottom line. 20 cents to the bottom line. You know who's more efficient? The homeless guy sitting on the corner putting his, this is unbelievable. Compared to Palantir, 78%. For every $100 they bring in, they add $78 versus 20 cents. Now, that I don't get. They're spending a lot of money on whatever it is. So let's do revenue growth. Mo?
Spending a lot of money on plants.
I'm going to go 20, 30, 40%.
Wow.
Which, by the way, is insane. It's insane.
The analysts don't even see that.
Okay, you're right. Let's do 10.
10, 20, 30, I think.
10, 20, 30. Okay, profit margin. Let's go 10, 15, and 20.
Okay.
Free cash flow, same thing. PE, let's go 15, 18, 21.
Okay.
15, 18, 21 on price of free cash flow. So what I've done here so far, guys, is I've put in low, middle, and high revenue growth numbers of 10, 20, and 30%. For 10 years, profit margin, 10, 15, 20. Guys, this is a pure guess. Look at these profit margin and free cash flow here.
And actually, I went over to Beyond Meat just to see if we could... No, they don't make profit either. So.
Okay. Now, PE at the end of 10 years, 15, 18, 21. Okay, they revolutionized the business. They're still growing, etc. Now, what's my desired return? Desired return essentially is your margin of safety, okay? The more unknowns you have, the more desired return you need.
So all unknowns.
Guys, I don't know any of these things right here being any sort of realm of possibility. I have no clue. But let's be conservative and call it 12 and a half.
Oh my God.
15 and 17. I just want to show how ridiculous the price is.
Okay.
Analyze button. $1.54. Well, if you believe all these guys, go for it. But there are a lot of assumptions up here that are a little confusing. Actually, I would sit there and say, now here's the hard part. The desired return here of 12.5%. Actually, Mo, maybe it's not a bad deal on the low side. Maybe it's not. But guess what, guys? This assumes profitability today. Yeah. They're not having that. So that's why this is wrong.
So they're not even close, and the industry leader is not even close either. That's the problem. It's the industry is the hard part.
This is exactly, and this assumes profitability today. Yeah. And the analyst expectations are that for the next 5 years, they still won't be profitable. That's why this is an avoid, even though this number is well above this number, because we don't know when the profitability will occur. Because if they don't have profit, they have to raise money in two ways to pay for the negative profit, for either issuing debt or issuing shares and diluting owners. Either one of those is going to affect this price even more to the downside. I have no clue if this is a reasonable price or not. So therefore I have to avoid. So if this makes sense to you, please subscribe to the channel, follow us. We do 2 or 3 videos a day. We go after people that we think are financial, shysters. Financial manslaughter is what I call it, when they don't realize that they're actually hurting you.
Financial criminals.
So guys, thanks very much. Subscribe to the channel. We'll see you later.
Killers.